So you've decided to start investing in ETFs. Smart choice. But there's a crucial decision that trips up a ton of new investors. Should you choose dividend ETFs that pay you steady cash right now, or growth ETFs that have the potential to skyrocket your money over time? One choice could mean consistent income, and the other could mean significant wealth down the line. If you pick the wrong one, you might waste years spinning your wheels without really seeing results. So let's get into both strategies so you know exactly how to pick the right ETF for you. First, let's quickly break down what an ETF actually is. ETF stands for Exchange Traded Fund. So let's say you want to buy shares of Apple, Tesla, Microsoft, Amazon, but individually buying these can be expensive and complicated. Instead, an ETF lets you buy one single thing that instantly gives you ownership of hundreds or even thousands of different companies. So it's simple, affordable, and gives you instant diversification, meaning you're not putting all your eggs in one basket. Popular ETFs you've probably heard of are VOO, SCHD, VTI, QQQ, each one investing in slightly different groups of companies and strategies. But here's the catch. Not all ETFs are the same, and choosing the wrong one could seriously slow down your wealth building. So let's start with dividend ETFs. These ETFs specifically invest in companies that regularly pay out their profits as dividends, usually quarterly, sometimes monthly. Companies like Coca-Cola, Johnson & Johnson, or ExxonMobil. Stable, mature companies that share their profits with you regularly. A few popular dividend ETFs are SCHD, VYM, JEPI. But why should you choose dividend ETFs? Well, they pay you cash regularly. So you literally get money deposited into your brokerage account. It's like a side hustle that you don't have to work for. This income can help you cover bills, supplement retirement, or let you reinvest to accelerate your growth even faster. Some advantages include steady, predictable income, usually lower volatility, meaning you can experience fewer dramatic ups and downs, and they're great if you're retired or just prefer receiving tangible income regularly. Disadvantages include dividend payouts are taxed every year, unless it's a tax advantage account, which I'll be making a video on soon. Another one is that they usually have lower long-term total returns than growth ETFs because these companies don't invest as aggressively in their own growth. And there's also a risk of chasing high yields from riskier dividend ETFs, which can trap you into poor performing companies. And before we continue, if you're enjoying this video, I'd appreciate it if you could drop a like and subscribe. It would really help out the channel. But let's get back to the video. So on the flip side, you've got growth ETFs. These ETFs focus on companies reinvesting their earnings back into themselves to grow bigger and faster. So companies like Apple, Amazon, Nvidia, Tesla, these typically won't pay you dividends, but they have potential for higher long-term returns through growth and stock price. So some popular examples include VOO, which invests in the 500 largest companies in the US, VTI, which invests in nearly every publicly traded US company, QQQ, which is heavy in tech. So some advantages of growth ETFs include higher potential long-term returns as growth compounds over time, also usually more tax efficient as you aren't constantly getting dividend payments taxed each year, and they're ideal for younger investors or anyone who has the patience to wait and watch their wealth multiply slowly but surely. But there's also disadvantages like no immediate income, so if you need cash flow soon, it won't help you. Higher volatility and bigger swings, which can be emotionally tough during downturns like the one we're in now, as of April 2025. And you need a long-term mindset to stick with it through inevitable market dips. So how do you actually choose between dividend and growth ETFs? So dividend ETFs might be for you if you want regular income right now, you're near retirement or don't want to risk big swings in your portfolio, and you simply prefer the psychological comfort of getting cash regularly. Growth ETFs might fit better if you're younger or have at least a 5 to 10 year investment timeline. Also, if you don't need immediate income, you want your money to compound and grow over time, and if you're okay with market ups and downs because you see the long-term potential. But here's a pro tip. You don't have to go all in on just one. In fact, mixing them can give you the best of both worlds, regular income and long-term growth. For example, you might choose 50% of SCHD for consistent dividends and 50% VOO for powerful long-term growth potential. And here's a bonus tip. Whichever ETF you choose, the best strategy is dollar cost averaging. That means consistently investing a small amount every month, whether the market is high or low. This approach prevents you from worrying about timing the market, reduces risk, and makes investing stress-free for the most part. Honestly, it's a cheat code for consistent wealth building. And I'm going to be making a video about this strategy very soon, so make sure you subscribe and stay tuned for that. Hopefully this video has cleared up the dividend versus growth dilemma. If you got some value and enjoyed the video, please hit that like button. It really helps the channel out. And if you're new here, make sure to subscribe. I've got a lot more coming up to help you build real lasting wealth. If you have any ETF questions or something specific you want to see covered next, drop a comment. I read every single one. There's also a Discord group and a newsletter linked below, and they're both totally free. Again, thanks so much for watching. I'll see you guys in the next one.